Hello guys and welcome again to my channel. So it's been a long time since I've uploaded and I wanted to really upload so that we can move on to the next topics. So basically, I really don't want to record now because my brain is so, what do you call this, so lazy, something like that. Maybe it's it's the thing. You'll become lazy if ever you let your brain tell you what to do. So if ever you wanted something to be finished, don't listen to your brain, just work, just act on it. So that's our first lesson for today. Don't trust your brain. So your brain wants comfort. Of course, if you wanted to do something again, do it immediately. Now, we are at merchandising already. So in the past video, I started with the merchandising entities, the accounting for merchandising entities. And I told you, if you can still remember, that merchandising entities are those that buy and sell finished goods already. So you're going to buy it at a cheaper price and then you're going to put a markup on it and you are going to sell it. Okay? Now, because it's a buy and sell operations, the merchandising entities are doing this. The transactions of the buying and selling is the ones that are unique if it will be compared with the service entities. Okay? And we talked about the buying portion, if you can still remember. So since the company, merchandise entities are buying, we've talked about first the transactions related to buying. Like for example, purchase on account. So what is the entry for purchase on account? I told you, the entry for purchase on account is debit purchases, credit accounts payable. So there is a new accounting title that will be used here if you're going to compare this to merchandising entities. I guess the black doesn't work. Let's move to using the blue whiteboard marker. So that's one thing. So that's the main transaction related to purchases. However, I told you also about the purchase discounts, in which what will happen is that when you pay within the credit terms, like for example, 5, 10, and 30, the meaning of 5 is you are going to get 5% discount when you pay within 10 days, right? 5, 10. And N30, that means no discount already if you're gonna pay within 30 days. So if it's like that, example 5, 10, and 30, if you're going to pay within 10 days, you are going to enjoy a purchase discount. So what will happen? Let's say, for example, you have an accounts payable of 1 million. So 5% of 1 million is 50,000. So there will be a purchase discount of 50,000. So what will happen is that you are to close your accounts payable of 1 million, for example, but I'm not going to put any numerical figure here. You're going to pay cash. But since this cash is lesser than your payable, because again, you have paid within the discount period, there will be another credit so that the entry will be balanced. We have purchase discount. So I've told you about that. So if you wanted to have a very detailed explanation about this, then go to the previous episode. I'll go through this fast. Okay? This is just a review, a recap. Okay? And I've told you all about also the purchase returns. That whenever you have been given some merchandises that does not fit on the agreement, like for example, the color, the quality, the brand, something like that, you have to return it. And what will happen is that you'll have debit, accounts payable, your accounts payable will be closed, And then credit, purchase, returns, and allowances. Right? So that's what we have talked about. And another is we talked about the freight in, whereby this is the cost that you have to incur in order to bring the merchandise that you have bought in the present location and condition, which is usually your store location. Okay, so that's freight in, like labor cost, transportation cost. So freight in or transportation in, depending on the company. Okay, so on the freight in, normally the entry is freight in, or again transportation in, and then credit cash. However, there's a twist here. You're only going to record this freight in credit cash if ever the shipping terms is FOB, shipping point, and then freight collect. Actually, if I'm going to make a discussion about this, actually there are two freights. We have FOB, destination, and FOB, shipping point. We have also two freights here, freight collect and freight prepaid. And the meaning of this, like for example, there are three meanings on the FOB destination and FOB shipping point. Let's start with FOB shipping point first. The meaning of FOB shipping point is that the title of the merchandise that you have purchased, the title, no, there's no point of view yet so that you will understand these things, okay? So there's no point of view. Here is the meaning of the FOB shipping point. The title passes upon shipment. So that means if the title passes upon shipment, the second meaning is that the goods that are in transit meaning after it's being shipped, it's in transit already. So that the goods that are in transit will be owned by the buyer already. So that's the second meaning. And the third meaning is that since the owner of the goods in transit are the buyers or the buyer already, are the buyers or is the buyer already, then the ones responsible for paying the freight is also the buyer. So those are the three things that you have to remember. Three sentences that are actually related to each other. Okay? Again, FOB shipping point, the title passes to the buyer upon shipment. That means the goods that are in transit are already owned by the buyer. And since they are owned by the buyer, they are the ones that should pay the freight. But the most important thing is that if FOB shipping point, freight should be paid by the buyer. That's the most important thing that you have to remember here. So on the three sentences that I've mentioned, the third sentence is the most important one. Of course, this is very much different from FOB destination because on the FOB destination, there are still three sentences. The first one is that the title of the merchandise will pass to the buyer upon reaching its destination. Okay? So that's the first sentence. And related to that, since the title passes upon destination only, then the owner of the goods in transit is the seller. Still the seller. Okay? Because in transit, that means it did not yet reach the destination. And the third point is that since the owner of the goods in transit is the seller, then the person or the party that should pay for the freight is the seller. Okay? So this is very much opposite with this one. Again, the third sentence is the most important one. Freight should be shouldered by the seller. Okay? So that's the most important meanings of FOB shipping point and FOB destination. But then again, you have to know those three. Okay? Now, if you talk about freight collect, this is simple. The actual payment actually paid buyer. Okay? So freight collect and freight prepaid only answers who actually paid for the freight. So on the freight prepaid, from the word prepaid, then that means actually paid by seller. That's the meaning of that. So if we talk about this entry, again, this entry is only possible if the shipping terms is FOB shipping point freight collect. It means the buyer is the ones that should pay the freight. That's FOB destination. And the freight collect, that means the buyer actually paid for the freight. So this is the entry. Okay? So if you wanted to know more about these things, again, you can visit the previous episode. The meaning will not be changed even if you become the seller. In this episode, we're going to talk about the point of view of the selling. The last episode is all about the buying. So the meanings of FOB shipping point and freight collect will remain the same. We will just change our perspective or our point of view. We will become the seller later. Okay? So those are the things upon review that I've talked about last episode. Now, before we go and go here on the selling aspect, let me tell you again that the new accounts on the buying portion of the merchandise entity are the purchases, discount purchases, returns and allowances, and freight in. So those are very important. And again, I've mentioned the purchases is just like an expense. So meaning the more purchases or the higher the value of the purchases, the net income will be lower. The same with expenses. The more the expenses, the net income will be lower. So you have to treat this as if as an expense. As you can see, it's debit. So it's like an expense. Also, the freight in is like an expense. However, these purchase discounts and purchase returns and allowances, actually, these are, what do we call this? Contra purchases accounts. So in contrast to purchases, the purchases discount and purchases returns and allowances, if they increase, the net income will increase also. So that is very important later on. Okay? Now let's go to selling. So when you buy, these are your entries, except if there are complications in the freight in aspect. So when you buy the goods, you have to sell them at a markup, right? So on the selling aspect, the point of view is you are the seller, you will record sales on account. So it's the same with this one. However, in that one, you are the buyer. Here, you are the seller. So what will happen if you sell on account? You have accounts receivable. And then, credit sales. So it's opposite, right? Purchase says debit. Here, the sales is credit. And instead of accounts payable credit, here we have accounts receivable. It's easy, right? Now, let's talk about sales discount. Now, as a seller, again, our point of view now is we are the seller. As the seller, you might want to encourage your customers to pay promptly or to pay within the discount period, which is why sometimes you offer, for example, 10, 15, and 30. That means you're giving 10% discount if they are going to pay within 15 days. Something like that. So that's your promo so that those customers will pay promptly. So what will happen? Of course, you will receive cash and then your accounts receivable, if ever, will be lessened also. But the cash that you're going to receive is a little bit lesser than the accounts receivable. Like for example, you sold 2 million worth of goods here. So meaning accounts receivable 2 million and then sales 2 million. You have offered 10, 15, and 30 to your customer. So they have paid within 15 days. So what will happen? the cash that you're going to receive, instead of 2 million, it will be lessened by 10%. So it's only 1.8 million. So from 2 million right here, because you're going to record here 2 million, you're going to receive 1.8. Okay? So the other debit, so that the journal entry will be balanced, is the sales discount. Very much the same with this one. However, there is a change in the point of view. Here you are the buyer, here you are the seller. Okay? Now, sir, what is this sales account? This sales account is a revenue account for merchandising entities and actually for manufacturing entities also. But let's stick to merchandising. So, this is a revenue. Instead of in the service entities, we have revenues, right? Here we have sales. And the higher the sales, the higher the net income normally. Okay? So, as you can see, the sales discount has a debit balance. This is a contra sales account. Okay? Actually, it's logical because if you give discounts to your customers, that means your net sales will be lower. Instead of 2 million, as you can see here, you have only 1.8. So, if you're going to be asked, what is really your net sales? So, 2 million minus 200 sales discount, that's the net sales. Okay? So, that's sales discount. And we have the purchase returns in here. We have sales returns. What if your customer did not like what he or she or it received, if it is a company, because you delivered a damaged good, or else the quality is not right based on your agreement, or the color, or other specifications, you've done it wrong. So they have to return it, right? So that's what do we call sales return. So what will happen? Of course, your accounts receivable will be credited. It will be lessened. And then you have sales returns and allowances. That's it for the sales returns. Again, it's basically the same as this one, but you're the seller here. You're the purchaser here. Okay? And we have freight out. So freight out, sometimes the seller, if you are a very good businessman, sometimes you wanted your buyers or clients to feel comfortable. So you are going to be responsible in the transportation or the freight of the goods that you're going to sell them. So that's what we call as freight out. Freight out, you're going to be responsible on bringing the goods to your customers and you have to pay a cost. Again, that cost is freight out. Okay, so what will happen? Normally the entry is debit, freight out, and then we have cash. In other companies, that is transportation out. So it's basically like that. And you're going to have an entry like this only if ever, again, we have FOB destination and freight prepaid. Again, what's the meaning of that? Again, the meanings that I've talked about in the past episode until now, a while ago, those are fixed. What we are changing is the point of view. And today, in this episode, we are the seller. Okay? So since we are the seller, you have to enter this if ever you are the ones responsible for the freight, which is FOB destination. Because again, FOB destination, the ones responsible for the freight is the seller because the seller is the owner of the goods in transit, in which we are the seller in this episode. Okay? And then, freight prepaid, the seller actually paid for the freight. And since we're the seller, we have to have an entry like this. Okay? Sir, what if FOB destination, freight collect? If that is FOB destination, so that means, as a seller, you are still responsible for the freight. However, freight collect, that means the buyer paid for the freight. So what will happen? Still, you will have freight out. you are going to make an entry, freight out as a seller if you are the ones responsible. And then you have credit accounts receivable because again, you are not the ones who paid for the freight, it's actually the buyer. So what will you do? You will decrease your receivable from your buyer because he has or it has paid for something that you should pay. Because again, FOB destination, you should pay for the freight. They paid under freight collect. Okay? Sir, what about FOB shipping point freight collect? FOB shipping point, that means the freight is to be shouldered, should be shouldered by the buyer. And freight collect, that means the buyer actually paid for the freight. So what will happen? You have no entry because you are not the ones responsible and you are not the ones who paid for the freight. It's as easy as that. And lastly, sir, what if FOB shipping point freight prepaid? Here, you are not responsible as the seller because the buyer is responsible for the freight under FOB shipping point, right? However, you have paid for it. Freight prepaid, you actually paid for the freight. So what will happen? Since you are not the ones responsible, you will not make an entry freight out. Instead, you will add it to your accounts receivable and then credit cash. Cash because again, you actually paid for it as denoted by this freight prepaid. So again, FOB shipping point, freight prepaid. FOB shipping point, that means the freight is the responsibility of the buyer. Okay? Freight prepaid, that means you actually paid for the freight. So the responsibility of others, you actually paid for the responsibility of others. So what will happen? You have to put it on account against the buyer. So accounts receivable and then credit cash. Okay? Now, since this is the comparison already, let's have one last thing. Okay? So, one, merchandising is pretty much different because it buys and sells finished goods at a markup. It's different from services, service entities. Okay? And we have talked about that extensively in the past episode until now. The second difference that they have is the income statement. On the income statement of service entities, guys, you just have revenues less expenses. And that's it. You have the net income. On the merchandise entities, guys, it's basically the same revenue minus expenses. However, the revenues will become sales. However, these expenses will be subdivided into cost of sales and operating expenses. And then on the operating expenses, sometimes that is subdivided into selling expenses, general and administrative expenses. And sometimes there is finance expenses. But basically, cost of sales, OPEX, those are the two classifications, major classifications of expenses for merchandise entities in order to get the net income. So, the unique one, because the OPEX and the finance expenses is basically the same with this, the unique one is the cost of sales. But before we go to this cost of sales, sales minus cost of sales is what do we call as gross profit. So, cost of sales is very literal. So, what do you mean by cost of sales? Cost of sales is the cost of the goods that you have sold. So, when you sell at 1 million, of course, there is a cost or sacrifice that you have made. That is why you have sold 1 million. For example, you bought something at 800,000. That's why you sold it at 1 million. So, the 800 is the cost of sales. So, how do we compute the cost of sales? Because that is not present in the service entities. Here's how. I don't have any eraser, so pardon. So on the cost of sales, It's basically like a formula, but you will be able to understand it because it's logical. So, the cost of sales computation is actually beginning inventory. Basically, these are inventory that were not sold last period or last year, for example. So, beginning inventory, if we're talking about year 2025, and your year is January to December 31, this is actually the January 1 inventory, which is also the December 31 last year inventory, or those inventories that were not sold last year. So, beginning inventory. After getting the beginning inventory, which is the ending inventory of the last year, you have to put net purchases, or the ones that you have purchased current period. So the net purchases is actually computed using gross purchases. What is this gross purchases? The gross purchases is the 2 million that I've talked about a while ago, which is not yet deducted by purchase discount, not yet deducted by purchase return. So that is gross purchases. So you put the gross purchases, and then you have to less the purchase discount. And it's very logical. Why are you going to deduct this purchase discount? Because again, if you actually purchased 2 million and you enjoyed 100,000, for example, discount, then that means what you have effectively purchased is only 1.9, right? So it's very logical. So you less also the purchase returns. So those that you have returned from your supplier to your supplier because it's damaged and etc. You are going to get the effective purchases that you have. Okay? However, I told you that whatever it is, the price that you have paid your supplier, it's not enough to say that that is the cost that you are to pay now or pay later if it is purchased on account. You have to add another cost, the freight in, if there is. So if that happens, you have the net purchases. Because again, net purchases is the effective purchases that you have made. So gross purchases is not actually the effective purchases that you have made because you still have to deduct the purchase discounts, the purchase returns, and you have to add the freight in to get the ultimate cost that you have to pay now or pay later if it is on account to your suppliers. Okay? So, meaning, unsold last year plus your purchases this current year. That is what do we call as total goods available for sale. Which is again very logical. Because it's true. The things that you did not sold last year plus the purchases, effective purchases that you have had on the current year, you add them up, those are the total goods that you may be able to sell. The maximum that you'll be able to sell. The total goods available for sale. Okay? Now, this is the second to the last in order to get the cost of sales. Actually, if this is the total goods that is available for sale, you have to less it with the ending inventory. So for example, the total goods available for sale is 2 million. And then you go to your warehouse and then you found out that not all of the total goods available for sale was sold. There are ending inventory, unsold, which will become the beginning inventory next year. The unsold is about 300,000. That means the cost of the sold is 1.7 million. This is formula. However, everything is logical. Again, this is just, the cost of sales is just composed of three main components. First, beginning inventory, that means the inventories that were unsold in the past year, plus the second one, the net purchases or the effective purchases that you made during the year or during the period. And if you got that, then you'll be able to get the total goods available for sale already. And then, if you will not be able to sell this, then there will be an ending inventory, right? Because if you're going to sell this, total goods available for sale, ending inventory will be zero. So the total goods available for sale will become the cost of sales. So the third one is the ending inventory. If you can sell 2 million and there is a remaining inventory of 300,000, that means the cost of sales is 1.7. Okay? Okay? So that's the cost of sales or cost of goods sold. So that's basically the second major difference of merchandising versus service entities. We have the third one, but it will be on the next episode. However, before we end this particular video, let me emphasize that on the operating expenses, sometimes it is subdivided into selling expenses and general and administrative expenses. Selling expenses are those expenses incurred because of selling the goods. Like for example, uh, your salaries for your sales lady, or else the rent for your store if ever you have a store that has been rented, something like that, or commissions that you have to pay for the people who recommended your products. So those are selling expenses. So those that will not be classified on the selling expenses, maybe it's part of the finance expenses. Finance expenses, on the other hand, are those interest expenses if ever you have availed for a loan from third parties, from banks, and etc. Service charges from banks again. So those are finance expenses. Now, if it will not be classified as selling expense and it will not be classified as finance expense, it's in the general and administrative expenses. So on the administrative expenses, actually, the salaries of the personnel that are not actually in the buying and selling of goods, like vice president of HR, something like that, or executive vice president or president, those will fall under administrative expenses because they are administrative offices. Or the aircon in their office, the electricity, something like that, will form part of the administrative expense. So, basically, if it does not fall to selling expenses, if it does not fall to finance expenses, and administrative expenses, you classify it as general expenses. But normally, general and administrative expenses are lumped together. Okay? So, what will happen to the income statement of the merchandise entities? You'll start with sales. Okay? However, remember, the sales that we're talking about is net sales. Net sales in the sense that that is gross sales less sales returns and allowances and less sales discounts. So that's net sales. Sir, how about freight out? Freight out is actually, if freight in is included in the computation of the cost of sales, the freight out is actually part of selling expenses. Okay? So again, you'll start the income statement of merchandising entities with net sales. Gross sales, less sales discounts, less sales returns, and allowances. So we have net sales. And then we have the cost of sales. Again, this is the computation for the cost of sales. And you will get gross profit. And then you will less operating expenses, which has selling expenses and general and administrative expenses. And if there are finance expenses, you have to deduct that too in order to get the net income. So that's it for this episode. Let's talk about the third difference of service entities and merchandising entities in the accounting cycle already. They're just different in the preparation of worksheet. Maybe I'll have an illustrative example so that you will see how different they are in the worksheet. Okay? So that's it for this video. If this helped, please click like, subscribe, and hit the notification bell and share this video to those who might need it. Okay? See you on my next one.